All right, good afternoon, everyone, and thanks for sticking around for the last panel of the day. We're going to be talking about money, and honestly, who doesn't like that? My name is Samantha Robertson. I'm the Director of Global Energy Strategy at BitDeer. We are one of the largest developers of digital infrastructure and chips for Bitcoin mining. And I am pleased to be here with this panel of finance bros, and I'll kick it over to them to introduce themselves.
Sure. Hello, everyone. Sam Kiernan here, Business Development Lead for Galaxy on the data center team. We're a publicly listed data center developer and operator.
Hi, I'm John Chambers, IPD. We Texas-based, and we generate power and have investments.
Ted Warner, I run the Energy and Power Infrastructure Investment Banking Group at Northland. It may be a bank you haven't heard of before, but we have been incredibly active in the AI data center finance space, in particular as it relates to greenfield projects for Bitcoin miners transitioning into HPC AI, with probably the most notable client of ours is Applied Digital. Recently, and all the financings they've been doing in this world is sort of the first mover of the Bitcoin miners to make that transition.
All right, well, let's get into it, and we'll start off with the transition in particular. Why is it strategic for Bitcoin miners to evaluate their data center assets for the purpose of AI or high performance computing?
Sure, I'll go first. Since we were one of them, I think it's pretty applicable. When we think about Bitcoin miners and primarily their dominant asset is their access to power. And with this, if you want to call it AI boom, one of the main needs is access to power at scale quickly. The ability for miners to acquire just the EV multiple in comparison to traditional Bitcoin mining with respect to what they can get for some sort of PowerShell, bespoke build, build-to-suit deal with a hyperscaler or neocloud is just way higher. They're trading at much higher multiples. Yes, the CapEx is more intense, the financing is more rigorous, but as they think about the best way to monetize their megawatts, it's just a no-brainer.
Yeah, I'd agree with that. That's definitely the reason people started to make that transition. If you're at a Bitcoin mining company and you're frustrated with your 2 to 3 times EBITDA valuation, if you can take those megawatts and say, well, now I own an asset over here that is an asset that could be purchased by any of the large publicly traded, digital realties of the world, those digital REITs. I mean, those things, they trade at 25 times EBITDA. So that 2 times versus 25 times, regardless of how much more expensive it is, if you can say to the world that you own that asset, theoretically, the way the street thinks about it is maybe it doesn't have to trade in the public markets at 25 times, but that is the reason why you saw all these guys that announced those types of deals. They had huge runs in their stock, and it's still going.
So I actually want to dive deeper into that because everything in the market thrives on a narrative. And we're definitely in a hype cycle. If you're in this room and don't hear the word data center at least 20 times a day, I'll be shocked. But what is it when miners are seeking this EBITDA multiple and investors are looking for this to provide value to themselves? Is there any room for creativity in these deals? And are there any instances where these deals are announced and miners aren't actually seeing that pump in their stock that they're looking for?
Yeah, so I can first touch on the creative aspect. The Bitcoin mining landscape, as it pertains to some of the publicly listed players, there's different strategies. We've seen your pure play Bitcoin mining, we've seen pure hosting, proprietary, and then you kind of have a blend as well, where some of the miners have their kind of AI division and their Bitcoin mining division, and they segregated that in that respect. For those who want to dabble in AI and looking at converting some of their facilities, it really depends on their risk appetite and what kind of exposure and, I suppose, shareholder and investor set they want to appease to. These Bitcoin mining investors are completely different when we think about like hyperscaler or data center operator investors. The landscape is completely different, the business model is completely different, and also the associated risk, especially as it pertains to financing. Depending on the level of investment grade your tenant is, it's not just plugging in machines and signing up to a network. You got to solve for the demand side as well. So I think in terms of creativity, it really depends on the risk profile and what they can do with the underpinning asset as well.
Yeah, I think a great case study there, really to answer the question, are there times when you announce something like this and it doesn't go the way you hope? One of the best case studies there is probably TeraWulf, in the sense that they had, one of their early announcements was G42, right? It was a big lease, big number, and they did not get the pop in their stock that other guys were seeing. And then when they did a smaller lease with Fluid Stack, but it had that Google backstop attached to it, the stock absolutely flew. And that sort of touches on Sam's point, right? If I want my asset to be sold to Digital Realty and trade it 25 times and really command that multiple, the quality of the tenant and their creditworthiness and that lease is obviously paramount. If John and I are the tenant, it's not financeable, and the street understands that. We're just seeing a CoreWeave become financeable from a project finance standpoint, and outside of them, there hasn't been any other real true project finance and non-IG tenants. So I think that's a big reason why people are after the hyperscalers, because that's when you kind of can guarantee that your stock's going to have to go up.
So it seems that having an investment grade off-taker is paramount, and there's really only a few of those, whereas capital or enthusiasm around data center investment is seemingly infinite right now. So how do Bitcoin miners who are definitely not the experts in building these types of data centers stand out in a somewhat saturated market?
I think reliance on partnerships. And that kind of ties into your last question about getting creative and what I was saying earlier about risk appetite. Miners have certain fortes and expertise when it comes to operations, but maybe not building a tier 3, tier 4 data center with 5 nines redundancy. It's a whole different skill set and capital outlay as well. They have opportunity to partner with development firms, engineering, bringing in those expertise, but also capital partners. We think about getting financing and investment grade and credible tenants. There's different ways, right? Some of the bulge banks mightn't give you the financing. You can look to private credit as well, but we're starting to see a bit of a slew in preferred equity structures. Foreign investors, a lot of kind of FDI coming in, especially from the Middle East as well. They want to have a play in that. And as well, thinking about getting in early, taking a stake in miners as they're kind of thinking about that pivot and having those early conversations.
I think being creative in the sense of if you can identify the energy source first, that also makes it very attractive for your end user, which in this case would be the AI.
Yeah, I think the quality of the asset can drive a lot of the ability to be creative or be more attractive in the end. Like if you have, like for instance, because Amazon sat out after Liberation Day from the sort of leasing bonanza for a period of months, now they're back in the market, and if you talk to their head of leasing in North America and tell them you have 300 megawatts of 2026 power, like he's going to pay attention to you no matter who you are. That's going to make you stand out immediately no matter what your background is. And then there are plenty of other ways to work through third parties to make sure that you could bring in the skill set, or maybe in some cases they're just going to buy it from you and they don't want you to be involved. But, I think most Bitcoin miners, if they're big enough and have a site like that, they've got some financial capabilities and they'd like to go find a way to structure something creative and participate in that upside. I mean, that's really the purpose. So it's not flipping it. But yeah, I mean, that's a long way of saying the quality of the asset and the timing of the power in particular and the size, timing and size probably, that's the way to separate yourself.
Well, thanks for the scoop, Ted. I want to get into that in a little bit more detail because Bitcoin miners are very good at finding cheap power at scale. It's the crux of our survival. But when you think about the benefit of Bitcoin miners is that they're geographically or location agnostic. And so when you think about the quality of an asset and the criteria for someone like AWS or another hyperscaler, they have very different standards than Bitcoin miners. So how do you see them, giving up some of their preferences for speed to power? And are we going to reach a point where speed to power is the only thing that matters?
I think that example that I gave is it kind of answers that question. That seems to be changing in real time right now. Speed to power is really, really important. And I mean, even 2 years ago, and we were doing this 2 years ago, talking to the hyperscalers, the idea of a data center in Texas was a 4-letter word. I don't really know why. It's above my pay grade. I mean, their preferences change with the wind. Sometimes they like a state and then they don't like a state. And obviously Texas became in favor, but in the third quarter of 2023, they didn't want to talk to you if you had an asset in Texas. So it's really interesting. Those preferences have changed, but now I think with the way that demand, it just seems to be insatiable. Timing and size of power is so much more important than location and latency at this point. John's company is trying to do a lot of behind the meter, that's what they're after, and they're trying to be a first mover there. And you're seeing plenty of hyperscalers thinking about it. Only a couple are actually doing that. But I think in the end, if they're going to meet this insatiable demand, they're going to have to get comfortable with behind the meter, and the fact that you're seeing the Metas of the world do stuff like that tells you that all they care about is, okay, if you can deliver it to me quickly, it doesn't need to be on the grid with total redundancy.
Yeah, that's right, because it was for a long time, and still is, I think the preference is on grid, and now because the demand is there, and to build out the infrastructure to be behind meter is a great alternative.
Yeah, and I just want to add to that as well. The reason, in my view, as to why they're looking for such great access to power is typically just for the training, right? We see these smaller sites go for the inference in kind of tier 1 jurisdictions, DFW, Metroplex, Chicago, New York, etc. We call it small sites nowadays, or sub 100 megawatts, which is crazy to think, but that's a small site. Access to power is one thing, and they want it on a large scale. And there's not many sites left within a reasonable time frame, looking at 24 to 36 months, that you can get online front of the meter. As those kind of start to top out, we'll see more of the bigger sites. You're talking your multiple gigawatt sites that people have submitted their load studies and steady states and waiting for approval back. Start to see them coming online, 2030, 2032. But in terms of how to value that and adequately plan for that is a little difficult. So I think people are going to be kind of pushed, and by people I mean hyperscalers and neoclouds are going to be kind of pushed up against the wall with respect to finding power soon, and maybe kind of leading into that behind the meter solution, whether it's gas or otherwise.
I guess we should also caveat this, that we're kind of thinking of this through the lens of flyover country, right? I mean, the market, obviously, in Virginia, is completely different. I mean, they don't even talk about price per megawatt. They talk about acreage values, and it's $3 million an acre in some places. No one here would be getting that kind of a return on an asset. So that's a different market. I'm definitely more focusing on the areas where we're seeing where there is a large Bitcoin mine. It's typically not in a major city, right? It's where people went to go find stranded power.
So I think that this kind of goes back to the idea of creativity. When we think about lenders or project finance, that's usually pretty traditional or even rote in a lot of ways. So as hyperscalers are getting more creative, going behind the meter or teaming up with Bitcoin miners or other partners, do lenders see any execution risk in the longevity of those assets?
I haven't seen a lender preference for like grid versus behind the meter. I haven't seen that. What we have seen is like the market for project finance with hyperscalers right now for a 15-year lease, non-cancelable, with one of the hyperscalers is SOFR plus 225. It's great paper and it's very easy to get from pretty much every major bank. The market for non-IG at this point, I guess it's kind of just CoreWeave, but I don't know where Galaxy's deal was. I am talking to all those guys, and there's like half the banks are now comfortable with CoreWeave, I would say. And that cost of capital is sort of in that SOFR plus 450 to 475 range, I think. So it's a couple hundred basis points difference, obviously, just on the IG side, but I haven't had any experience with them assessing whether or not it adds more risk to have behind the meter. I'm sure that is just a function of like, if John and I roll up with a bunch of generators on the back of a truck, maybe but if it's somebody building real power, then I don't see how that would really change things.
Yeah, we haven't really seen a lot of publicly announced behind the meter structures. In terms of the viability and ability to get financing for these projects, it's just as rigorous as front of the meter, but it's also a lot more expensive. There's a lot more players involved in the value chain. And as we kind of think about these different people, it's hard to find a one-stop solution in the sense that these structures have to have the stars align. And what I mean by that is, it's easy to find a midstream that will give you all the gas in the world, but doing the power gen is out of their scope. Getting these people to align, having the financiers credit check and get everything wrapped up is a little more tedious, a little bit more hairy, but I don't see it being impossible.
I think that what's interesting about this is that we're talking about this from the perspective of finance, but also technology companies, like who really just see more solutions than problems always. But when you're thinking of hard infrastructure, it moves slowly, and there's a scarcity of access to grid power and other electrical equipment that we need to actually build these data centers. But I'm curious if you have any opinion about other bottlenecks that are talked about with less attention that are a barrier or where capital needs to flow to really get these deals over the finish line, or these projects.
Well, I certainly think the biggest bottleneck so far has been just getting generators. I mean, if you look at Caterpillar, where it's like, I think anywhere from 24 to 28 months for a brand new one that's going for about like 1.1 million per megawatt. That's probably the biggest issue I see.
Yeah, you're not meeting timing needs. In this case, we're talking more, that's just the backup generation. But, outside of a couple guys in the of the top like 7 or 8 people building these big data centers, most of them want backup gen. So that's a bottleneck, obviously. But in terms of like the financing, I don't know any other ones off the top of my head. Maybe you can be more creative, Sam.
No, capital's not the problem, and neither is demand. Yes, there's only a couple of hyperscalers, but people are going to start bleeding into the neoclouds and enterprise clients. I mean, the enterprise clients are pretty slow to move traditionally. I think they're going to pick up the pace as things go on. But as far as bottleneck goes, it's really just the physical transmission upgrades and substation builds. I mean, MPTs, depending on the voltage, I mean, you're talking 30 months, right? Some of them 2024. And that's aside from getting regulatory approval to get load online, right? and talk about all the backlog of studies. It's really just a one step at a time, but yeah, there definitely is an electrical structure issue.
I think that backlog is actually really key. I mean, that's just the obvious issue that we're having in numerous states. And if your site can't deliver, within the next 15 months, they're going to go somewhere else. And as demand grows and as this keeps moving, I mean, do I think that we could see more bottlenecking there as it relates to just how quickly the utilities can get their act together and deliver on all these ESAs, or even start issuing them because they're so backed up in the first place? That definitely could happen. It's probably driving a lot of the interest in behind the meter too.
Well, that's right. I mean, just if you think about like the transformers and the substations and the upgrades alone and the field studies and the approvals, that's just very kind of time consuming right now.
And it's tough to get financing right now to just build out like a substation, right? I mean, that's a difficult thing to do unless you know that, like, unless someone's giving you an ESA that says, this power is going to be here within 12 months, but like, as long as you go get the money, like that's something that we could definitely go finance, because 2026 power, for example, even though you're not going to have a data center built, is worth a lot of money. And there are plenty of lenders out there that will take a chance on that, especially with a publicly traded company. They will see the value in that and go, all right, fine, my money goes into your substation. Now this property that you have is worth a ton more. But they would need to know that the timing of that power is really soon, and it's there and it's material.
So do you think lenders are sophisticated enough to understand that value of power available within the next 12 months?
Yeah, I think most of them, I mean, they talk frequently to the hyperscalers. If they're in that space, they understand it. And if they're in the equipment lending side, they have to be exposed to this. So they definitely understand it. And they're looking at all these different transactions and seeing what are people paying for these powered land sites when they do change hands, and then what are these data center companies, like what are these assets trading at when they're finished, and they're just realizing. I mean, that's how we got Applied Digital did some MOIC-based, secured debt to help finance their build before anyone was really doing this. And the reason we got Sim Group and Macquarie comfortable with that was they were just looking at actually the Bitcoin mining transactions that had happened, right? So if someone buys a 300 megawatt Bitcoin mine, what did that trade on a per megawatt basis? Those were the types of multiples that we were using to get them comfortable with the idea that that's like the minimum value of this collateral. Like if they had more certainty, obviously, because there were LOIs in place with hyperscalers that this was going to become an AI data center. But even if they're not, they're sophisticated enough now to be able to look at the sites and say, yeah, there's a pretty good chance that the floor value of this place, if I build out the substation, is X, and I would lend Y against that.
Interesting. Well, I want to just ask two more questions, and I think one of them has to be kind of a doomer one. We're talking about demand for data centers. We know that's seemingly insatiable. Capital's not a problem. But what about demand for AI? And if that doesn't materialize in the way that hyperscalers or other companies envision, who's left holding the bag?
I think demand for power, demand for compute is not going. With respect to what type of compute, AI, things are moving that way. The only, I want to touch on like sustainability, and what it ties in is I don't think the rate of GPU production efficiency increases and the price is sustainable. I think you can draw some parallels with respect to what we've seen over the last few years in Bitcoin mining, and how that we had the whole ASIC run, selling JPros at $110 a T is just not realistic. I think we're kind of there as well in the AI side.
Yeah, I'd agree with that. Don't have much to add on that front.
I concur.
Sam. I was just going to say NVIDIA, but that was much more eloquent. Thank you, Sam. All right, so then the last question, and it's also somewhat related to sustainability, but I've seen multiple reports that if it weren't for capital expenditures related to AI, the US would likely be in a recession. And so with that, do you consider yourselves public servants?
We're just doing our part.
Yes, absolutely.
Yes.
Wow, and aren't we so
You're
grateful
welcome.
for you are. All right, well, give it up for the Finance Bros keeping this show together.